Owning a home is a dream for many people. A home purchase usually involves a mortgage, since a typical home buyer does not pay the full cost out of pocket and upfront.
A mortgage is a loan used to finance the purchase of a home. In a mortgage agreement, you, the borrower, get the loan amount or principal approved from a company known as the lender, after you contribute a percentage of the home's sale price, known as the down payment. You agree to pay off the mortgage in monthly installments, each of which consists of a portion of the principal and the interest fee, within a number of years such as 15 or 30 years, which is known as the loan term.
More than 80% of the first-time home buyers in the U.S. use conventional mortgage loans that are provided by private lenders and backed by U.S. government-sponsored mortgage companies, Fannie Mae and Freddie Mac. Other types are FHA, USDA, VA, and portfolio mortgages, but are less common. A conventional loan is a great option if you have a solid credit score and little debt.
You can get a conventional loan with a down payment of as little as 3% of the purchase price of the home. However, if you put down less than 20%, you'll usually be required to pay a monthly fee called private mortgage insurance or PMI.
Many people prefer a fixed-rate mortgage, the interest rate for which remains unchanged throughout the life of the loan. The most common home loans are 30-year and 15-year fixed-rate mortgages.
A variable rate option called adjustable rate mortgage, or ARM, is also available. The initial interest rate for an ARM may start as fixed, but then adjusts over time based on market rates.
Mortgage rate, which is the interest you pay over the life of your loan, is a critical factor in making the mortgage decision. The lower your interest rate, the cheaper your loan will be. If you have a strong financial profile, your loan will cost you less.
The interest and a portion of the principal are paid as part of your monthly payment for your home loan. If the lender is authorized to pay the property taxes and homeowner's insurance, they would also be part of your monthly payment. Your lender will hold on to this money in an escrow account and pay them off when the tax and insurance premium are due.
You will also see another rate on your mortgage documents that is known as the annual percentage rate or APR. The APR is the annual cost of your mortgage, including interest, closing costs, mortgage insurance, discount points, loan origination fees, and other loan fees expressed as a percentage. This rate is usually higher than your mortgage interest rate. The APR tells you what you are really paying, sometimes much higher than the mortgage rate offered by the lender. Keep an eye on it to get an idea of the not-so-obvious costs baked into your mortgage.
An indirect way of reducing your interest rate is using a buy-down option to pay discount points upfront at closing. One mortgage point would represent 1% of the loan amount. Each point you purchase will buy down your mortgage rate. Over time, the lower rate can save you money. Go for this option only if you plan to live in the home for several years, so as to recoup the amount you paid in points.
On the other hand, a lender credit, which is a cash credit you receive from your lender at closing, helps you cover some or all of your mortgage costs at the expense of a higher interest rate.
The interest rate is determined by two factors: current market rates and the level of risk the lender takes to lend you money.
Factors such as your FICO credit score, loan term, and location of the house are in your control. However, other factors such as prevailing market rates, federal monetary policy, economy, and the current state of the housing market are outside of your control.
There are several important steps you should take before applying for a mortgage.
The lender would be trying to avoid the risk of default or non-payment. Therefore, as a home buyer, you need to present yourself as a financially strong, low-risk buyer.
The loan underwriter will review many documents to assess your creditworthiness to make a determination for loan approval. Therefore, make sure to maintain a decent history of paying your bills and rent on time.
Reducing even a fraction of a percent on your interest rate can save you thousands of dollars over the life of your mortgage loan. So, it definitely pays to prepare, shop around, and compare offers.
In general, consumers with higher FICO credit scores receive lower interest rates than consumers with lower credit scores. You need to have a credit score of 620 or above. If your credit score is less than that, you may not be able to get a loan.
Review your credit report to make any corrections or work on improving your credit score by paying off outstanding debts, credit card balances, etc.
A healthy financial situation means you are not drowning in debt, so a lower debt-to-income or DTI ratio is preferred. Usually, borrowers with DTI over 43% are considered riskier. Therefore, it's recommended that you keep your DTI below 43%.
Once you made up your mind to buy a home, it's a good idea to get a pre-approval from your mortgage lender before you start looking for homes. Getting pre-approved upfront can tell you exactly how much you will qualify for, so you don't have to waste time shopping for homes outside your budget. When you're ready to make an offer, you'll attach your pre-approval letter to your offer so that the seller can be sure you'll be able to get a mortgage.
Save a down payment of at least 20% before applying for a mortgage. If you pay more down, you are in effect reducing your loan-to-value ratio, or LTV, which will reduce your risk profile and translate to better interest rates and easier qualifications. If you put less than 20% down on a conventional loan, you must pay private mortgage insurance, PMI, until you reach a loan-to-value ratio of 80%. Also, applicants with smaller down payments usually have a higher interest rate.
Save an additional amount for mortgage fees such as application fees, appraisal fees, title search and insurance fees, closing costs, etc. Know your options. Also know that you can shop around for some of the closing services, but not all. Do not opt for mortgages that charge fees if you pay off your loan early.
Do not open new bank accounts or credit cards or personal loans or anything else that calls for a credit check, as that can negatively affect your credit score. The money in your bank account should stay relatively stable during the mortgage application process.
Since job stability is very important to the lender, try to avoid or minimize job switches or unemployment around the time of the mortgage application.
Use a mortgage calculator to run your numbers to make sure that you are not overburdening yourself with a mortgage. Make sure that the total cost of the home purchase is well within your budget. A general rule of thumb is that you shouldn't spend more than 43% of your income on your monthly debts, which is the upper limit of your debt-to-income ratio that we talked about earlier.
The monthly payment for a 30-year mortgage is usually much less than that of its 15-year counterpart. However, a 30-year loan generally incurs you more interest rate than a 15-year one. Note that you'll be building up your home equity much faster with a 15-year loan.
Although adjustable interest rate of an ARM may have a lower initial interest rate, it's generally considered risky, as its rate could climb much higher after a few years.
Keep your financial records in order. Most lenders ask for 2 recent pay stubs, 2 most recent tax filing documents, and the last 2 or 3 months of bank account statements.
Pay attention to the housing market and the interest movements and make your move when the odds are favorable for your mortgage application.
You need to have a range of interest rates that you want to lock your rate within and a maximum amount that you can afford to pay on a monthly basis. If you get a rate in term, those satisfy these conditions, you can go ahead and lock in the rate.
Get a clear picture of different fees and discount points that you are paying as part of the loan costs to avoid any costly surprises. Sometimes these fees can inflate your overall out-of-pocket expenses even when the interest rate is very attractive.
Homes in a flood zone need flood insurance. Factor that into your total mortgage costs if it is applicable for the home of your interest.
Make sure to thoroughly review your loan estimate document and final closing documents to ensure correctness of dollar amounts and the terms and conditions.
And finally, make sure to place your coins in such a way that you can comfortably pay off your mortgage as legally agreed to the lender. The last thing you want is default on your mortgage payments, forcing the lender to foreclose your home. Don't let that happen. And that's all for today.
Thanks for watching.
Please like, share, and subscribe if you found this channel useful.